lead in there makes it sound like we should be heading into the next bull market and growth environment in the economy, Danny. But, I think that Derek's perspective would be that maybe we're more in the eye of the hurricane. The question might be, how big is that eye and what is the data going to look like between now and the other side of the storm? And I think after we talk through that a little bit, we'll also talk about how you might approach positioning your investment portfolio to mitigate some of that risk.
Right. I mean, one of the challenges, Mark, really throughout this year has been, we know the Fed has raised rates at the fastest pace in history. And then when we had Silicon Valley Bank go under towards the end of March and the Fed stepped in very aggressively along with the FDIC, that was when the NASDAQ bottomed. Interest rates had declined somewhat, and there was concern that crisis was going to morph into something bigger. And what we've seen is that damage has been contained, at least for now, and the labor market continues to be strong. And the economic data recently has actually surprised on the upside. We got a good consumer confidence number. We got some good housing numbers. The inflation report on Friday was somewhat benign, although the comps are going to get easier. And by that, I mean energy prices were up significantly a year ago. They're now down, and those comparisons become easier, meaning that it's possible inflation could uptick in the coming months.
And despite some of those upticks that we are seeing that would be, like you said, surprises on the upside, at the same time, what we're seeing and hearing from the media is the recession is coming, And it's really difficult to kind of navigate through those things and figure out how to balance both sides of that equation. And I think there's some moves from the Fed's perspective that we have to look at, because remember, we had a debt ceiling debate and the Treasury was drawing down its reserves. And so that had to get refilled also. So a lot of different pressures from monetary policy standpoint, figuring that out in terms of will we be in an environment 6 months from now that's going to be slowing earnings growth?
I mean, right now, our positioning essentially is neutral. We're a little bit overweight international stocks for valuation reasons. We're a little bit underweight large cap growth also for valuation reasons. And thus far, we have not seen the rotation back to more cyclical companies that we expect. We do expect to see that in the second half, because if the threats of a recession have been postponed, perhaps into 2024 or even later, you would expect to see more cyclical areas of the economy and the stock market gain some relative performance advantage. In addition, the valuations, those top 7 stocks, which many people are now calling the Magnificent Seven, have reached levels that are somewhat unsustainable. I mean, obviously the businesses are very good, but the valuations are very rich. So it's hard to see a ton of upside there. So when you're looking for opportunities, I think you really want to look at stuff that actually performed poorly in the first half of the year. Just like at the beginning of 2023, the real strategy was to look at the stuff that had done the worst in 2022 because due for a reversion to the mean.
You talk about that Magnificent Seven. I love the way that our industry has to put those labels on things. It's very creative, and I like it because you can kind of go back in time and mark those periods, based on those headline-making acronyms that we put together and names. But that one in particular is interesting to take a look at, how dramatic the spread has been between the return for the first 6 months of the year on the Magnificent Seven versus the rest of the 493 companies in the S&P 500. And if you look forward, somehow or another, those two things have to converge. And it'll be interesting to see if that's the Magnificent Seven coming back down to earth or the rest of the economy moving into a growth cycle.
Right. And that's the million-dollar question. And one of the things about market cap weighted indices is when the largest stocks outperform the general market, they simply become bigger in that market as a whole. And as a result, when you've got passive ETF buying and you've got momentum investors chasing those stocks, it can create a very unstable situation where essentially a lot of the relative performance gains can be eviscerated in a fairly short period of time. But when I think about those 7 stocks, I mean, all of them in my mind are actually very sound businesses. They generate a lot of free cash flow. They're nowhere near as expensive as the tech stocks were at the peak of the tech bubble in late 99, early 2000. So they're probably going to sustain those valuations for a time. Now, they may have to work them off over time. For example, NVIDIA is trading at over 220 times earnings and almost 50 times revenues. But again, it's in a great position, but it does take time. And these chips are expensive, and the benefits from AI will take place over decades, not weekends.
Right. And that valuation move that was been happening over months, it seems like, to digest what might take decades really to materialize. But, I think about that too in terms of people the perception of risk, and I've had this conversation with a lot of clients, and they say, boy, it just seems like there's so much more volatility in the markets now. But, some of that may be driven by that heavy market cap weight that you've been talking about.
Well, I think it certainly has. I mean, the volatility index, which we look at as a measure of fear, is trading at around 13, which is about as low a level as it's been in about 5 years. So there is a lot of complacency out there. And in addition, there are many folks, who are fully invested bears, essentially. They're riding these stocks, but they don't necessarily believe in the valuations. They just have to be there or they'll get fired.